Hello everyone, welcome to Property Finance with Lee. Today we're diving into purchasing and financing property within your self-managed super fund. SMSF loans are something I've been getting a ton of inquiries for lately, but seems to confuse people quite a bit. In this video, we'll go over the structure of an SMSF, how the financing relationship for a property within the SMSF works, and how banks assess SMSF applications. I need to make this clear though. This video does not contain tax or legal advice. This is for entertainment purposes only. SMSF structures are complex, and whatever you plan to do in regards to purchasing or financing property should be done in consultation with an accountant, a lawyer, and/or an SMSF specialist. With that being said, let's jump in. What does the setup look like? I'm going to keep this as basic as possible. In this setup, you have the members, the SMSF structure, the lender, the bare trust structure, and the property in question. Let's begin with the members of the SMSF. Most of the time, it's a single individual or husband and wife. Although, depending on the state, SMSFs allow for up to 6 members. The SMSF structure is made up of an SMSF trust and trustee. The bare trust structure is made up of a bare trust and trustee. Then of course we have the lender and the property in question. According to the ATO website, trustees of self-managed super funds are generally prohibited from borrowing money, subject to limited exceptions under the super law. One of these exceptions is for limited recourse borrowing arrangements. An LRBA involves an SMSF trustee taking out a loan from a third-party lender. The trustee then uses those funds to purchase a single asset or collection of identical assets that have the same market value to be held in a separate trust. Any investment returns earned from the asset go to the SMSF trustee. If the loan defaults, the lender's rights are limited to the asset held in the separate trust. This means there is no recourse to other assets held in the SMSF. What we have just read on the ATO website is adhered to with what's called a limited recourse loan. A limited recourse loan is one in which the lender can't go after more than the collateral offered for the loan in the event of a default. In practice for SMSF lending, this means that what is at risk is the property being purchased and any additional security provided by a member which is outside the SMSF structure. Essentially, the law prohibits using other assets within the SMSF structure as security for a loan on another property. And yes, it also means that you can't use the equity built up in one SMSF property as security to be used in another property's financing. For this arrangement to work, the property must be purchased within a bare trust structure. A bare trust trustee simply holds property of and on behalf of the beneficiary, in this case, the SMSF. The trustee has no discretion and no active duties other than to transfer the property to the beneficiary when required. This transfer happens once the loan has been paid out. The property moves from the bare trust structure to the SMSF structure. To illustrate this, let's use an example. Jack is a member of his SMSF. He finds a property with a solid rental return he thinks will make a great investment for his retirement. Jack has sought professional guidance through his accountant, which has set him up with a bare trust structure, which he will use to hold the property's title. Jack's next step is to see Lee from Setters Property Finance, which assists him in getting an SMSF loan for the property. I did a great job and was successful in helping Jack get an SMSF loan. Jack's SMSF saved contributions and the lender's loan flow through the SMSF structure, enabling the bare trust structure to acquire and hold the property's title. The SMSF structure is the beneficiary of the bare trust structure, whilst the lender has security over the property under the terms of a limited recourse loan. Rental income then flows through the SMSF structure, which then forwards loan repayments to the lender. Once the loan is paid in full, the bare trust transfers the property to the SMSF, and that's that. So how is Jack's borrowing capacity for an SMSF loan worked out? Let's have a look at this SMSF serviceability calculator. The property Jack found is worth 500k. Jack is going to contribute 20% of the property's cost from cash held by the SMSF. We know we are going to need a loan amount of 400,000. Currently, this lender has an SMSF product with a 6.94% interest rate, and we can see that the application gets judged at a sensitized rate 2% higher at 8.94. Let's leave the loan type as variable, the loan term set to 359 months, without an interest-only term. It's a residential investment, The SMSF costs around $2,000 per year to run. Jack earns $160K per year, which means there's mandatory super contributions by his employer of $17,600 per year. The property is going to achieve a $500 per week rental. We have $120K in cash in the super account. There are no other investments within the SMSF structure. The purchase price, like we mentioned, is $500K. And for simplicity's sake, let's leave all associated property fees out for now and say we're going to contribute 100% of the shortfall from the SMSF's cash reserves. What are the results? Well, we can see that we failed the net disposable income test on these figures. The NDI is worked out by the total net income of the SMSF and its expenditure. So how can we make this work? Well, if Jack agrees to make an additional $100 each week in super contributions, the scenario now passes a serviceability test. There is a lot more to it than this, but I just wanted to give you a very basic understanding of the way lenders assess these loans. They look at the income generated within the SMSF and the contributions made to the SMSF. A question I get a lot is, what about the excess cash within the SMSF? Can you use an offset? Absolutely. There are SMSF products out there which allow for a 100% offset account to be used. Just note, this is not a personal offset account, but an account belonging to the SMSF. So you can't use it for your own personal expenditure as you would a typical offset account. Can a loan be fixed or variable? Yes, both options are available. How about an interest-only period? It is more expensive, but that's also an option. Can you purchase and finance a commercial property instead? Yes, again, the applicable interest will be higher than a standard resi investment, but you most certainly can. Guys, again, I'm not an accountant or a lawyer. What was mentioned in this video does not constitute legal or tax advice. If you have specific questions relating to tax advantages, the structure itself, contact your accountant, tax advisor, lawyer, or SMSF specialist. If you have sought professional advice and want to explore SMSF lending for a property purchase, contact me from the details below. I'm happy to assist you. If you got value out of this video, drop it a like, and if you want to see more content like this, subscribe. I'll catch you guys in the next one.